Welcome to this explainer. Today, we're going to break down the exact, precise rules from the Inland Revenue Authority of Singapore, or IRAS as we all know them, for legally zero rating your exports. Look, if you're a GST registered business moving goods out of Singapore, getting these rules right isn't just important, it's absolutely critical. So we're going to use this structured blueprint to give you a really clear step-by-step path to stay compliant and avoid some seriously costly errors. Okay. Let's just dive right into it by addressing the massive financial risk that's kind of hiding in plain sight for any business handling overseas transactions. Incorrectly applying a 0% GST rate, yeah, that can lead to severe adjustments and a whole lot of unexpected GST liabilities down the line. We want to make sure you aren't leaving money on the table, sure, but more importantly, we need to ensure every single export transaction is totally bulletproof when it comes to IRS compliance. To keep everything super organized, here is our compliance blueprint. We're going to cover 1. The basics of zero rating, 2. Direct versus indirect exports, 3. The 60-day rule, 4. The crucial export documentation, and finally, 5. When you absolutely must charge that 9%. All right, kicking things off with Section 1, the basics of zero rating and the foundational rules. So the crucial takeaway here is that you've got to be absolutely certain at the exact point of supply that the goods are actually leaving the country. And of course, you must have the paper trail to back it up. Zero rating isn't just about the physical movement of the goods, it's completely dependent on your intent and your evidence at that exact moment. You literally cannot guess. You can't just assume it's going overseas. Certainty and documentation, those are your two twin pillars here. Moving right along to Section 2, direct versus indirect exports and the path your goods take. Now, this brilliantly illustrates the real dividing line in tax law. It essentially all boils down to one thing. Do you maintain custody and control over the shipment, or does your customer? Think of it this way. Direct exports put you firmly in the driver's seat. Indirect exports, well, that means you basically handed the keys and all the control over to someone else before the goods have even left Singapore. Let's look at an example. Say Company X manufactures electronics and ships them to a customer in Indonesia, and they use a freight forwarder that they appointed themselves. They control the whole process because they're the ones making the export arrangements and keeping the required documents showing them as the exporter. This direct export scenario easily qualifies for zero rating, well, provided their paperwork is actually in order, of course. But on the flip side, what if Company X sells those same electronics to a German customer, but delivers the goods to that customer's appointed freight forwarder right here in Singapore? In this case, the default rule is actually that you have to charge GST. Why? Because you lost control the minute those goods hit the local forwarder. To zero rate this scenario, you have to overcome that default by meeting some incredibly strict certainty and documentation rules, which we're going to look at right now. That brings us to Section 3, the 60-day rule, or as I like to call it, the ticking clock. This timeline shows a very rigid compliance window. If you issue your invoice or receive payment on, say, January 1st, 2026, which locks in your time of supply, the countdown starts instantly. That means you have exactly until March 1st to not just physically get the goods out of Singapore, but to secure every single piece of supporting paperwork in your files. Honestly, if you miss this 60-day window, you simply cannot charge 0% GST. It's as simple as that. Okay, Section 4, crucial export documentation and the burden of proof. Since the burden of proof is entirely on you, for direct exports, you're going to need two distinct categories of evidence. Starting with transaction documents, your baseline evidence has to include your customer's purchase order, the sales invoice you issue to them, proof of payment received, and this is critical, properly endorsed delivery notes. And listen, a standard run-of-the-mill delivery note just isn't going to cut it for IRS. To actually be valid, that delivery note must be endorsed by the freight forwarder with 3 very specific details. Number 1, a clear statement saying the goods delivered are for export. Number 2, the freight forwarder's name, address, and GST registration number if they have one. And number 3, the actual date they collected the goods. If literally even one of these details is missing, your documentation is deemed incomplete by default. No exceptions. And right alongside those transaction docs, you've got to retain your transport documents. This means a bill of lading or an airway bill that explicitly names you as the exporter. Now, if you're exporting goods by land, you need an export permit stating you as the exporter, and crucially, the specific vehicle number must be on that permit. If the vehicle number isn't known when you do the permit declaration, you've got to make sure it's stated on a supporting document later on, like your invoice or packing list. So what happens if the primary transport documents don't display your name? Well, in this case, your forwarder has to issue what's called a subsidiary export certificate. This is a highly specific document, and it's basically your lifeline. It must contain a serial number, the export permit details, your name and address, the transport document numbers, and an authorized signature. Without this certificate acting as a bridge, poof, you lose your zero rating eligibility completely. Furthermore, if you're dealing with an indirect export, where, remember, you lack custody and control, the documentation burden gets even heavier. You also have to obtain written instructions from your customer, directing you to deliver the goods to their forwarder, along with a written confirmation from them, guaranteeing the goods are strictly for export only. And you have to pair all of that with either transport documents in your name or that subsidiary export certificate we just talked about. All right, let's wrap this up with Section 5. When to charge 9%, or in other words, failing the criteria. Because whenever you fail to meet the rigorous criteria we just outlined, this is the exact GST percentage you are legally obligated to charge your buyer, 9%. If your paperwork is incomplete, if it's got errors, or if you simply miss that 60-day window to get the goods out and collect your evidence, zero rating is completely off the table. Let's just look at a few red flag scenarios so you know what to watch out for. Rule of thumb: never assume an export will happen. If a local customer tells you they might export the goods later on, you cannot zero rate it. If the goods are just sitting around in a warehouse waiting for instructions on whether they'll be sold locally or shipped overseas, you don't have certainty. In all of these cases, you absolutely must charge 9% GST at the time of supply, even if those goods do eventually end up crossing the border months later. So, as you go back and review your own company's internal compliance processes, I want you to ask yourself this one critical question. Does your current paperwork truly guarantee certainty at the exact time of supply, or are you unknowingly setting yourself up for a pretty devastating tax adjustment down the line? The tax man doesn't deal in maybes, folks. Don't wait for an audit to find out your 60-day process is broken. Go check your files today.